Good morning, guys. Welcome to Mug Briefing. Right now, one of the world's biggest tech companies just did something unusual, even by Wall Street standards. Alphabet, the parent company of Google, went into global bond markets and raised about $31.5 billion in a single coordinated fundraising push. In simple words, Alphabet borrowed a very large amount of money from investors to help pay for its next wave of artificial intelligence infrastructure and other big capital projects. It matters now because it signals how expensive the AI race has become and how confident investors are that Alphabet can carry that debt for decades. What actually happened is not one simple loan, but a bundle of bond deals executed at the same time. Between February 9th and February 10th, 2026, Alphabet launched and priced multiple tranches, which are slices, of debt in different currencies. The biggest piece was a US dollar offering that expanded to roughly $20 billion after investor demand came in stronger than expected. Alongside that were sterling bonds in the United Kingdom and Swiss franc bonds in Europe. When all the tranches are added together, reporting from Reuters and other outlets puts the total at about $31.5 billion. The deal has been priced and sold. This is not a plan or a proposal. The money is raised, subject to normal settlement mechanics that follow any bond issuance. The most eye-catching piece is a 100-year sterling bond worth £1 billion, roughly $1.3 billion, priced at about 6.125%. A 100-year bond means investors are lending money for a century in exchange for regular interest payments. In practical terms, no one expects the original buyer to personally hold it for 100 years. Bonds trade in secondary markets, so investors can sell them, but the structure locks in Alphabet's borrowing cost for an extremely long time. Investors accept that length because they want predictable income from a highly rated company, and some institutions, like pension funds, manage money on very long time horizons. Reports say the sterling century bond attracted close to 10 times more demand than supply, and books for the dollar tranches reportedly topped $100 billion in orders. Those demand figures come from deal reporting based on bank bookrunners' order books, which is standard practice in bond markets. Is this Alphabet's largest debt raise ever? Reporting describes it as one of the biggest corporate bond sales in recent tech history, though Alphabet has issued large debt before. The key point is not financial distress. Alphabet is not borrowing because it ran out of cash. The company remains profitable and cash generating. Instead, it is choosing to add long-term debt to fund an unusually heavy investment cycle. Why do this now? The most direct reason is timing and scale. Alphabet and other major tech firms are pouring money into AI data centers, custom chips, and cloud infrastructure. These projects require huge upfront capital. Raising debt spreads the cost over decades rather than draining operating cash in the short term. There's also a strategic element. When markets are receptive and demand is strong, companies often raise more than they strictly need to create a cushion. Locking in funding today reduces uncertainty if interest rates or credit conditions change later. Coverage links the raise to accelerated AI spending, and while analysts interpret that connection, it matches Alphabet's publicly discussed capital expenditure trajectory. The company has not published a line-by-line allocation for the proceeds, and large corporate raises are typically used as general funding pools rather than earmarked accounts. This deal also drew attention because analysts described the bonds as relatively covenant-light. A covenant is a contractual protection for investors, like restrictions on future borrowing. Fewer covenants mean Alphabet has more flexibility. That description comes from market commentary analyzing the bond documents, not from a marketing slogan. Strong demand suggests investors were willing to accept lighter guardrails in exchange for yield from a top-tier issuer. What this likely means is that investors are betting Alphabet's long-term business will comfortably support the extra debt. Supporters argue this is efficient financing for growth: borrow cheaply today, build infrastructure, and earn returns over decades. Critics point out that ultra-long bonds shift risk onto investors if interest rates rise or if the company's outlook changes. Pension funds and insurers that buy very long bonds face interest rate risk, meaning the bond's market value can fall sharply if rates move higher. Alphabet gains flexibility and cash today, but it does increase leverage, which is the ratio of debt to overall financial strength. For now, markets appear comfortable with that trade-off. For Americans, the effects are indirect but real. If the money accelerates AI infrastructure, U.S. consumers may see faster rollout of Google AI tools, cloud services, and data center expansion. Large infrastructure projects often translate into construction work, engineering jobs, and regional investment where facilities are built. For investors, especially pension funds and retirement systems that hold corporate bonds, returns will depend on future interest rates and Alphabet's credit quality. A successful mega issuance can also influence borrowing costs across the economy. When a company as large as Alphabet raises money easily, it can make conditions friendlier for other corporations seeking financing. What could happen next follows normal market logic. Other tech giants may attempt similar large bond deals to fund their own AI spending. Ratings agencies will continue to monitor Alphabet's balance sheet, though there's no immediate signal of downgrade pressure in current reporting. If interest rates rise sharply, the market price of these bonds could fall, which affects investors who want to sell early. Alphabet could issue additional debt later if capital needs expand, but that would depend on market conditions and company strategy. It is important to separate this from common misunderstandings. This does not mean Alphabet is in financial trouble. It does not mean the company is running out of cash. Issuing debt does not guarantee AI investments will succeed, and strong investor demand does not make the bonds risk-free. It simply shows that markets currently trust Alphabet's long-term stability enough to lend at scale. The story would become more serious if Alphabet's debt rose rapidly without matching growth, or if heavy AI spending failed to produce returns. In that case, leverage could become a concern, and refinancing future debt might get more expensive. Viewers watching this space should look for signals like changes in Alphabet's credit ratings, announcements of even larger capital spending plans, similar mega deals from competitors, and how these bonds trade after issuance. Secondary market pricing often reveals whether early enthusiasm holds. Stepping back, the situation is a snapshot of the AI era's economics. Alphabet has chosen to borrow $31.5 billion across global markets, including a rare 100-year bond, to help fund infrastructure it expects to use for decades. Investors responded with overwhelming demand, signaling confidence in the company's durability. The move does not signal crisis, it signals scale. The scale of money required to compete in modern AI, and the willingness of financial markets to finance that bet.